What's going on, everyone? So today I'm going to be doing a demo of how to use my short-term rental calculator. So you're going to be able to analyze your next short-term rental deal. So when you download the calculator, on the left, anything in light green is going to be something that you're going to fill in yourself, and then anything in the light red, it should be auto-calculated through the forms or the functions of the cells. And well, why is this important? Well, anytime you go to buy an investment property, you have to make sure that the property is going to do well for you. And one of the best ways to do that is to project out future revenue and expenses that are associated with that property. Now, I will say it's not enough to just project out before you buy the property what it's going to do and how it's going to work for you as far as return on investment and fees go. But you also should keep proper bookkeeping, right? So don't just come up with a deal calculator and say, oh, I got a 25% cash on cash return on this investment and not actually keep track of your financials after you buy the property, right? So make sure you're keeping good, accurate books and records. If you need help with that, I would recommend check out QuickBooks or Stessa for that. But anyway, anything in green we're going to input ourselves, and then the red should flow naturally. So in this example, we have a asking price 600,000. We're going to offer 585,000. We'll use a 15% down payment. Let's assume 3% for closing costs. We have 10,000 in renovations and then 35,000 in staging costs. And if we're able to predict out, again, ADR and occupancy, we're able to come up with gross income, right? Monthly gross income, yearly gross income, as well as net operating income, monthly, yearly net operating income, right? On the right, we have financing. So this mortgage amount will auto-calculate from the difference between the offer price and the down payment. Determine the interest rate. I already have a function in here that is going to auto-calculate this, but this is assuming that we just have your principal and your interest in here. This is not counting, say, insurance or property taxes, which you'll account for here. I could build that in if I wanted to, but it's not going to be all encompassing. Not everybody's going to have that. So I decided to leave insurance and property taxes out of it for this example. So next, you're going to list your expenses. And again, these are going to be on a monthly basis here, just so you know. So I have it says monthly here. Total expenses monthly and annual. And then this is where it's going to kind of filter into like gross income, net operating income. And then you're going to have some of your investor metrics down here. So most people, they're going to use cash on cash, look at their cash on cash and kind of make a decision from there. But I think it's also important to have what's called DSCR, which is whether or not the income from the property actually services the monthly debt payment. And so typically lenders nowadays are going to want to see that this is at least 1.0 or greater. Although, in my experience, a healthy DSCR is anything that I would say is 1.5 or 2.0. Cap rate, this is more used in multifamily or commercial than we do see it in short-term rentals, but it's still very interesting because a lot of valuations in the commercial and the multifamily space are based on cap rates. So cap rate is a function of just taking your net operating income divided by the purchase price to get your cap rate. And then lastly, this is one that I think is really the most important one on all of them too, is the payback period. The payback period represents how long is it going to take me in years to recoup my money from this investment. So all it really measures is going to be your net operating income divided by your total investment. This basically tells you, hey, here's how many years you're going to hold this property for in order to get your investment back. And obviously, this doesn't include anything like inflation or time value of money or cap appreciation, right? This is just purely based on the cash flow. And me as a CPA, I had to also kind of add in here some of the tax goodies. So this is kind of how this is going to work. So you will put your filing status, whether you're single, head of household, same thing, or you're married. You're going to go ahead and toggle that here. You're going to put your W-2 / your business income total. So this is going to be all the income that you make outside of real estate, whether you work a day job, you're self-employed, you own a business, whatever it is. You're going to put your W-2 income here. And then here, total rental income for all properties. This isn't just going to be your STR, but all inclusive of all the rental properties that you own, you're going to want to put in your total, yearly cash flow that you're projecting out total, without mortgage principal payment, because remember, we can never deduct the mortgage principal payment. Okay. And what this is going to do is kind of show you a comparison between what are the tax savings that you're going to have if you don't do a cost segregation study versus what are the tax savings that you are going to have if you do a cost segregation study. Now, this what you'll find is that doing the study can sometimes take your 25% cash on cash and turn it into a 45% cash on cash, which I think is really powerful too. Now, a word of caution with this is this isn't all inclusive. Okay, there's a lot of steps and important things to note that go into qualifying for doing the cost segregation, as well as being able to take the loss against your income. So you're going to want to speak with either me or a different tax professional on whether or not this applies to you. And I do have a video up here in the top left that kind of walks through some of the steps to qualify and whatnot. But assuming you're able to qualify for that, this calculator is going to kind of show you some of the tax benefits that you can have by buying that short-term rental or buying this deal, whatever it is. And what you'll find out is that a lot of times it will boost your cash on cash for the first year tremendously when you factor in the tax savings. And this just assumes a 15% land allocation as well as 25% bonus depreciation. So this is my calculator, guys. So feel free to leave some feedback or maybe some suggestions on maybe what I should add in here. I mean, there's a lot more that I could add in here, but I kind of want to just get you guys started. And this is a great starting point when you go to analyze your next deal or maybe some more deals that you might have. So I appreciate you taking the time and checking it out, and send it to a friend. If you find this helpful, definitely share it, send it to a friend. Let somebody else go ahead and download this and bless their life too. So thanks everyone, and hope you have a nice day. Bye.
Thanks so much for taking the time to check out this video. You probably watched this because you're a real estate investor who feels like they're paying way too much on taxes. And it's not your fault. They don't teach this in school, and most real estate investors have bad accountants who don't know the real estate tax code like we do. If you don't mind, I'll share the 3 best perks of working with us. Number 1, you get access to a community of over 250 tax-smart investors. Number 2, you get one-on-one calls with your own tax strategist. And number 3, you get weekly calls with me discussing personal finances, real estate investing, and of course, taxes. If you had all this, do you still think you'd pay that much in taxes? If you're interested right now in learning how you can craft a tax strategy game plan, my team is standing by ready to take your call. Just use the calendar below to book your free tax consultation.